Hi guys, welcome back to Father and Son Investing. This is a follow-up for your U.S. Treasuries after the FOMC meeting yesterday. The take-home message from here, bottom line up front, is going to be patient. Be patient, and I think that you will get to see a little bit more yield, particularly out of your Treasury notes. I'm going to give you 3 reasons today why you should be patient. It's going to have to do with the FOMC meeting. It's going to have to do with the issuance of U.S. Treasuries in the near future, at least over the next year or so. And the third one is going to have to do with Japan, of all places in the world. So stay tuned. This is the headline from the Wall Street Journal this morning. Higher interest rates not just for longer, but maybe forever. Now, not really forever, because nothing is forever, but they're indicating at least that it would be extended longer than we earlier anticipated. That was really the take-home message from Jerome Powell in this announcement. How long should we anticipate longer? To answer that question, we're going to turn to the summary of economic projections that was also released yesterday. This is actually a great way to get a synopsis of where the Fed thinks that markets and interest rates and GDP and all sorts of things are heading. I want to turn us to the dot plot. You can think of each of these little blue dots as representing a member of the committee. And we're going to look at 2023 and 2024. We're actually going to look at 2024 first. That'll give us an idea of how much longer we might expect elevated interest rates. If we look at 2024 and we try to look at each of these dots, roughly the middle is going to be right about here. That's going to be in about the 5.1% range, the 5.5 to 5.25. We'll call that 5.1%. So you're looking at 2024, if we were to take kind of a median here, that the committee thinks we're looking at about 5.1%, at least as of yesterday. Now let's turn back to 2023 for just a moment and look at something interesting. Again, each of these blue dots represents a member of the committee. We'll see that for 2023, there are some of the committee members who really think that we're done raising interest rates. And that's each of these blue dots here. That would be keeping it at the current 5.25 to 5.5% rate. However, there are more committee members here who favor increasing at least one more time, seeing that as the midpoint range. Now, there are 2 more Fed meetings for 2023. There'll be one in November and one in December. So 2 opportunities still to raise interest rates. And as of yesterday, when they issued this dot plot, there were more committee members who felt like they should be raising the rate one more time. Now, I'll tell you, though, that not all of these committee members are voting members, because the presidents of the regional Fed banks, they take turns being a voting member of the committee. So what we don't know is how many of these ones favoring an increase are actually voting members. Nevertheless, that gives us an idea of where the Fed members think interest rates will be, particularly out into 2024. That was really the news that kind of shook the bond market yesterday, and even really the equity market, indicating that these rates would be higher for longer, just as we stated. Number 2 reason why you should be patient here a little bit is that the Treasury is going to be issuing even more notes and bonds than they have in the recent past. Just how many more Treasury notes and bonds will the Treasury be issuing? Well, we're going to use July as kind of a baseline. In July, it was $246 billion worth. In September, so occurring now, Treasury will increase its issuance of notes by 24 more billion, up to $270 billion. In October, so just next month, we're looking at an even bigger increase, going up to $281 billion worth. Now, that is a lot for these 2 months, but what might we expect over the next year? Well, according to the Treasury Borrowing Advisement Committee, in their neutral scenario, we would be looking at potentially notes and bond issuance up to about $350 billion in August. So you can see just how much the Treasury may be ramping up note and bond issuance as those numbers increase. That increases that supply, potentially bringing the price down and increasing the yield. So there's reason number 2 to be patient, and that has to do with the number of notes and bonds that the Treasury may be issuing. Let's turn to reason number 3. This is a pictorial representation of the foreign holders of U.S. debt. This is as of December 2022. For the country that we're interested in here, the most recent numbers I could find were still pretty similar, and that is about $1.1 trillion for Japan. They purchase U.S. Treasuries as a way of hedging It has to do with the dollar versus the yen. And so for them, purchasing U.S. Treasuries has been advantageous because purchasing Japanese bonds, which have been yielding almost nothing essentially for multiple years now. However, recently the Bank of Japan has changed their stance on their Japanese bonds, and they're willing to let rates or yields rise as high as 1%. You may be thinking 1% doesn't sound like much compared to what you get in the US right now. But let me show you the reason why these entities in Japan would be interested in purchasing Japanese bonds instead of US Treasuries. The reason that Japanese investors might be more interested now in purchasing their own bonds has to do with the hedging costs. You can see here that in the past, when US Treasury yields were low and the dollar compared to the yen was more in favorable terms, at least for Japanese, it was advantageous to purchase US Treasuries. However, as US Treasury yields have gone up and the dollar versus the yen has been less advantageous for the Japanese, the hedging costs have made it such that it's to their advantage now to purchase their own Japanese bonds. And as this rises towards that 1% yield that the Bank of Japan is willing to let it get to, this spread is going to grow even wider. In my estimation, over the next few months, I think it's highly likely that we'll see a large amount of that 1.1 trillion that is currently invested in US Treasuries out of Japan going back home to Japan, or in other words, repatriation of that money back to Japan. So that's reason number 3 why being patient may be helpful. You're asking, how is that helpful? Well, as the Japanese sell those US Treasuries, or at least don't buy as many of them, that's going to make the supply of US Treasuries for other investors greater. And as that supply increases, I would look to see the price come down, and thus the yield goes up because, of course, price and yield on bonds move inversely. So there are 3 reasons for you to be patient. When I'm talking about patience, I'm talking about over the next few weeks to a couple of months here. Let's just get a quick look as we wrap up this video at what the US Treasuries have been doing after that FOMC announcement. Let's just take a look at how the Treasury market has reacted as we wrap up this video. Over here on the right, you'll see the 5-day graph of what the Treasury notes and bonds and bills have been doing. And here in this column, you can see the yield change. So looking quickly at this, we'll notice that the 2-year and the 3-year have come down just a little bit today, but obviously they shot right up yesterday with that announcement. There's the rapid increase in the 2-year. So it's come down just a little bit today, but I expect that this is going to reverse and start going up again over the next few days. 2-year and 3-year are the ones that I'm the most interested in, but even the 5-year, 7-year, 10-year have responded well, and even out to 30-year Treasury bond responded by increased yield with that announcement yesterday. Not so much movement going on with the Treasury bills, but these don't have as much room to run. They're right up there near that Fed funds limit. In fact, the 6-month Treasury bill is actually higher than that 5.25 to 5.5 Fed fund rate. What am I most interested in is that 2-year and 3-year note. I bought my first 2-year note at 5%. It's since come up to about 5.15%. I only bought just a little bit because I'm anticipating things can still go higher here. There's still more room to run, but 5% is where I had set my limit. So the same limit is what I'm thinking mentally for the 3-year note. When it gets to 5%, that's when I'm interested in purchasing. Again, purchasing just a little bit, expecting that it still has room to run up a little bit. The 5-year and the 7-year, those start getting a little more difficult to predict interest rates that far out. Even the dot plots become a little bit more difficult, but that 2-year and 3-year note are kind of right in the wheelhouse of that Fed funds dot plot that we looked at earlier. So that's what I'm interested in, the 2 and the 3-year. I'm waiting, being patient for that 3-year to come up, and the 2-year is looking really quite nice. I think it still has a little bit more room to gain some more yield. I hope this was interesting and informative for you. If it was, please give us a thumbs up. And as always, until next time, enjoy your investing.